Right now, as of October 2025, the top 10 companies in the S&P 500 make up 38.7% of the market cap of the entire index. And that's up from 18% in 2000. We've nearly doubled the amount of concentration in just 2 decades. And think about what that means for your retirement account. If you own an S&P 500 index fund, and most of you probably do, 40% of your portfolio is riding on the performance of 10 companies. I'm Terrell Higgins, and in a world filled with information, what you're really looking for is transformation. And in today's video, we're going to be discussing a risk that most people don't realize they're even taking: portfolio concentration. Let's get into it. Here's something that might shock you. Between 1926 and 2019, researchers analyzed right around 29,000 US stocks. And do you want to guess how many of those stocks actually outperform just holding a boring US Treasury bill, one of the safest investments you can buy? Just 1,092 stocks. That's right around 4% of the stocks. But wait, it gets even wilder. Only 86 stocks generated 86% of all the wealth creation in the stock market across that time frame. So that's only 0.3% of the stocks generating almost all of the market returns. This 2019 study by Hendrik Bessembinder proves that because of skewness in the stock market, picking a winning stock is nearly impossible. So if you felt like individual stock picking is impossible, you're not wrong. The math literally proves it. Most investors realize not to put all their eggs in one basket. But what they don't realize is that their basket might be already getting tilted without them knowing it. Let me show you what I'm talking about. So right now, the top 10 companies in the S&P 500, they make up about 38.7% of the index. That's right. 40% of your money is riding on the outcome of these 10 companies. And here's what happened recently. So in 2023, the Magnificent Seven tech stocks drove 75% of all the gains in the S&P 500. Incredible, right? But when AI hype cooled in 2024 and the market corrected, those same names contributed to 15 to 25% drawdowns. So your diversified index fund suddenly didn't feel so diversified. This is called concentration risk. And most people think about concentration in obvious ways: too much in one stock or in one sector. But there are actually 5 key types of concentration. And the 5th one, people often overlook. So the first one is individual stocks. And we already covered this, but the odds of picking individual stock winners is astronomically low. Most stocks underperform their benchmarks across their lifetime. It's like playing a game where the odds are stacked against you. The second is company size. Large cap stocks hold about 60% of all global equity market cap. And that's up from 40% in 2010. During the COVID recovery, large cap stocks surged 40%, while the small cap stocks lagged behind with only 10% gains. But if you're only invested in large cap, you're missing out on an entire segment of market opportunity. The third is sector concentration. Tech made up 10% of the S&P 500 in 1990. but it is 34% of the S&P 500 right now. If we think back to the dot-com bubble, tech dropped 78%, wiping out $5 trillion worth of wealth. But if you were diversified out into other sectors, your portfolio recovered faster. The fourth is growth versus value. Growth stocks have been on an absolute tear. Growth stocks have generated 80% of the market gains since 2010, but they're not without their risk. So in 2022, growth stocks lost 30% of their value. But if you were in value stocks, you would have actually gained 5%. Tesla is a perfect example of this. So if you bought Tesla in early 2020 and held to its peak in 2021, you would have generated 1,300% gains from that stock. You hold past that, it would have absolutely cratered your portfolio all the way through 2023. The fifth risk, and this is the invisible one, country concentration. So US stocks actually make up 60 to 70% of global market indexes like MSCI World. This is up from just 50% in 2000. And if you're an American with a US heavy portfolio, you might think you're diversified because you have hundreds of US stocks, but you're actually massively concentrated in one country's geopolitical system, currency, and economy. And as Americans, we've been very lucky, but it's not hard to imagine a world where all this currency risk and geopolitical risk turns the other way. And here's something that keeps me up at night about a concentrated portfolio. Momentum does not last. So research from Jagadish and Tietman's 1993 study, which was updated in subsequent years, showed that top performing stocks in 1 year actually tend to underperform the market the next year. And those winners, they tended to lag the losers by about 1% monthly after 12 months. Stocks that hit a 52-week high, they tended to reverse course by 4 to 5%. You remember Peloton, the absolute darling of 2021? They've lost 92% of their value since then. So the market as a whole tends to revert to the mean, it bounces back. But individual companies, they can go to zero and never recover. Just talk to people who've invested in Lehman Brothers. That concentration feels amazing on the way up and catastrophic on the way down. Now let's talk about something that on its surface sounds risky, but it might actually be safer than concentration for generating better market returns. Leverage. Now, this is not financial advice. Talk to a financial advisor before considering any borrowing or investing strategy. And I know, Dave Ramsey just had a heart attack.
That's just stupid. Of course you're broke, because you're stupid. Stop it.
But hear me out. Let's say you have $100,000 and you invested in a globally diversified index fund. You would expect your returns to be right around 7%. And if you invest that $100,000 for 10 years, your $100,000 investment is going to turn into $197,000. Now, let's assume that you take out a loan for an additional $100,000 at 4% interest. And you invest that $100,000 alongside your $100,000. Now you have $200,000 working for you in the market. Net of fees, doing a simple simulation, your money is going to grow to $259,000. So assuming those steady returns and you were never forced to sell, that is a 30% gain over your unleveraged returns in this investment. And here's why this might be safer than individual stock picking. You're amplifying the returns on a well-diversified portfolio and not betting everything on Tesla or GameStop. So research from Ayers and Nailbuff's 2008 Yale study shows that young investors using moderate amounts of leverage early in their careers and slowly backing it down as they age can improve their wealth at their end of life by 50 to 100%. The key words here are moderate leverage. We're talking 1.2x to 1.5x, not 10x leverage on your overall portfolio. The math here is simple. When you are young, you have time to recover from market crashes. In 2008, the market went down 57% peak to trough, and it took about 5 years for the market to recover. If you're 25, that's nothing. If you're 60, that's your retirement. But, and this is critical, leverage amplifies everything, including losses. In 2008, the market went down 57%. And if you use 2x leverage, that means you were down over 100%. So in theory, you could have lost everything if that margin was called. Could you stomach that? Could you actually watch your account get cut in half and not panic sell at the bottom? Because here is what the research shows. Investors sell 60 to 80% of the time at the bottom of market downturns. They lock in market losses at the worst possible time. And there's a behavioral trend worth noting here. Men tend to overestimate their risk tolerance, especially after experiencing large market gains. They overestimate by 10 to 20%. Women tend to more accurately assess their risk tolerance. But this isn't about biology. This is about overconfidence. And overconfidence plus leverage means that you could completely blow up your account. Quick sidebar, if you're thinking about leveraged ETF products like the 2x and 3x ETFs, you need to be very careful because these funds reset daily. And that creates something called volatility decay. So in a choppy market, you could be losing value even though the underlying index isn't even moving. So in 2015, when the markets got choppy, some of those 3x ETFs actually lost 10% of value, even though the underlying index barely moved. And it can get way worse than that. So in February of 2018, when volatility spiked to 37%, the inverse ETF product, XIV, actually lost 93% in a single day. They had to liquidate $2 billion and the fund disappeared. That's right, the money disappeared. So these ETFs are a tool, and just like any tool, it can help you or it can hurt you. So you need to be very careful. So here are the practical takeaways from today's video. And the first one is to avoid individual stock picking unless you have a genuine advantage. And you're most of the time not going to have one. You don't have insider knowledge like Nancy Pelosi or some company CEO. So mathematically, your bet is going to be wrong, and most stocks underperform their benchmark. The second thing is to diversify globally. You don't want to have a home country bias. You want to own the whole world to limit your risk. The third is diversifying across factors. You want to own small cap and large cap companies, value and growth companies. You don't want to concentrate into a single sector. You want to maximize your odds of your investments being successful. And then the fourth, and this is not financial advice, but if you're young and you have the risk tolerance, leverage can be a powerful tool for building wealth. You want to use low interest debt like a 401k loan, a HELOC, or a security-backed line of credit on your account or a margin loan on your brokerage account. And you want to keep the leverage minimal, 1.2 to 1.5x, and slowly taper it off as you age. But the last thing, and this is the biggest thing, you have to understand yourself and your risk profile. If you're going to panic sell at the bottom of a market downturn, you should completely avoid leverage. It is better to get rich slowly than to chase returns with leverage and completely blow up your account. If you got some value out of my video today, please like and subscribe to the channel because I'm going to be transforming your finances every single week. And look, I get it. It's exciting to try and pick the next Amazon or leverage up your account to an early retirement. And seeing your account double or triple in a year is absolutely exhilarating. But building long-term wealth isn't about excitement. It's about managing your risk, understanding your own personal risk tolerance, and maximizing the probability that you're actually going to reach your goals, regardless of which stocks won or lost, which sectors boomed or busted, or whether your home country underperformed or outperformed. The boring solution is almost always the correct solution. Keep getting 1% better every day, and I'll catch you in the next video.